While you were sleeping last night, something unprecedented happened in the global silver market. Not on trading floors, not in hedge fund offices, not in the dark pools where institutional money moves in silence. This happened in retail stores, in shopping apps, in the hands of regular people across multiple continents who suddenly, urgently, desperately needed to own physical silver. And what I'm about to reveal to you is not just another price prediction video. This is documentation of a paradigm shift happening in real time. A shift where the most average, most mainstream populations on Earth, people who've never thought about precious metals in their lives, are now racing to convert cash into silver bars faster than suppliers can keep them on shelves. My name is William Lee, and I'm about to show you why what happened at Costco in America is just the visible tip of an iceberg. Because while American suburban families were cleaning out Costco's 2.4 million ounces of silver inventory in 72 hours, and yes, that number is real, and I'm going to break down exactly what it means, something even more significant was happening on the other side of the planet. In China, silver has become the new gold. Not metaphorically, literally. Chinese state media is running daily segments about silver investing. Television programs are encouraging Chinese households to stockpile physical silver. Financial advisors are recommending silver allocation as standard practice. And the Chinese population, with their legendary appetite for saving and their deep cultural connection to precious metals, is responding in numbers that dwarf what's happening in the West. Let me be very specific about what this means. When Costco sells out 2.4 million ounces in America and makes headlines, that's significant. But when China, a nation of 1.4 billion people with a savings rate of 45% compared to America's 5%, when that population collectively decides that silver is essential, you're not looking at a trend. You're looking at a tidal wave that will reshape global commodity markets permanently. And here's what makes this absolutely terrifying if you're not positioned. The major banks know. The institutional short sellers who've dominated silver price suppression for decades, they're quietly closing their positions. Not because they think silver will go up 20% and then correct. They're closing because they know this time is different. They know that what's coming is not a spike. It's a repricing, a permanent structural repricing where silver doesn't go to $50 and come back to $30. It goes to $100, then $200, then possibly $800 over the next 10 years, and it never comes back down to where it is today. This is not speculation. This is pattern recognition from someone tracking global capital flows, supply chain dynamics, and sovereign accumulation strategies. And by the end of this video, you're going to understand exactly why physical silver, not paper, not ETFs, not mining stocks, but actual metal you can hold, is about to become one of the most sought-after assets on Earth. And why the window to acquire it at anything close to current prices is measured in weeks, not years. Let's start with what happened at Costco, because it's the perfect case study of what occurs when mainstream populations wake up to monetary instability. Costco, the place where American families buy toilet paper in bulk and $5 rotisserie chickens. That Costco just experienced a run on silver so severe that they sold their entire inventory, 2.4 million ounces, in 72 hours. Let me put that number in perspective, because most people hear 2.4 million ounces and it doesn't register. That's 74.6 metric tons of silver. That's the weight of approximately 60 cars. Costco members collectively bought the equivalent of 60 cars worth of silver in 3 days. But it's not just the weight that matters, it's what that represents in market terms. Global annual silver mine production is roughly 850 million ounces. Costco just moved 0.28% of annual global mine production in 72 hours through a single retail channel. The entire United States Mint, which produces American Silver Eagles for the government, sells roughly 15-20 million ounces per year. Costco just sold the equivalent of 1 month of U.S. mint production in 3 days. The largest silver ETF in the world, SLV, holds about 500 million ounces. Costco sold 0.48% of the largest silver ETF's holdings in 72 hours. Think about that. A bulk retailer known for selling paper towels and frozen pizza just moved an amount of silver that would be significant if a major institution did it. But this wasn't an institution, this was individuals. Thousands of individual Costco members making independent decisions to buy physical silver, and they did it so aggressively, so urgently that they overwhelmed a supply chain designed to handle enormous volume. When Costco employees checked their inventory systems, they were posting screenshots on Reddit showing that silver products were being purchased faster than they could physically update the back end. Hundreds of orders per minute. 100-ounce bars, gone. American Silver Eagle tubes, gone. Everything gone. But here's what makes this a global story rather than just an American retail phenomenon. This is happening everywhere, and nowhere is it more significant than China. I've been receiving reports from contacts in Hong Kong, Shanghai, and Beijing that are absolutely stunning. Chinese state television, CCTV, which is government-controlled media, has been running segments almost daily for the past 2 weeks about silver investment, not gold, silver. They're profiling families who've converted savings into physical silver. They're interviewing financial experts who recommend silver allocation. They're running educational segments about how to verify purity, where to store it, how much households should own. This is unprecedented. Chinese state media doesn't randomly decide to promote a commodity investment. This is coordinated messaging. This is policy guidance disguised as news coverage. The Chinese government is actively encouraging its population to buy physical silver. And when you understand Chinese culture around gold and silver, metals that represent security, wealth, and status for thousands of years, you realize what's about to happen. Let me give you specific data points. Shanghai Gold Exchange, which handles the vast majority of physical precious metals trading in China, reported that physical silver delivery requests in the first week of January 2026 exceeded the entire month of December 2025. We're talking about a 300-400% increase in physical demand in 1 week. The premium for physical silver in Shanghai, meaning what people will pay above the spot price to get actual metal, has spiked to $8.12 per ounce compared to the normal $2-3 premium. Chinese refineries that typically process silver for industrial use are being flooded with orders from investment channels. Pamp Suisse's Chinese operations, major refiners in the Shanghai Free Trade Zone, they're all reporting order backlogs of 6 to 8 weeks compared to the normal 2-week turnaround. And most tellingly, Chinese citizens are being advised by state media to keep their silver purchases quiet, to store them securely at home, and to think of this as multi-generational wealth preservation. Do you understand what that means? The Chinese government is basically telling 1.4 billion people, a population with a collective savings pool estimated at $20 trillion, that physical silver is essential for protecting wealth, and Chinese households, having lived through currency instability, economic volatility, and governmental control of assets, take that guidance very seriously. Now let's talk about scale. If just 1% of Chinese households decide to allocate 5% of their savings to physical silver, we're talking about $100 billion of demand. At current prices around $32 per ounce, that's 3.1 billion ounces. Annual global silver mine production is 850 million ounces. Do the math. Chinese household demand alone, at those conservative estimates, would represent nearly 4 years of global mine production. That demand cannot be met. It's physically impossible, and this is where the repricing mechanism begins. Because unlike stocks or bonds or cryptocurrencies, you can't just create more silver when demand spikes. Mining new silver takes years. Expanding refining capacity takes years. The supply is what it is, and when demand overwhelms supply in a physical commodity market, price is the only variable that can adjust. This is why the banks are closing their short positions. For decades, major bullion banks, JP Morgan, HSBC, Scotia, have held massive short positions in silver through the COMEX futures market. These shorts allowed them to suppress price, profit from downward movements, and maintain control of the market. But something fundamental has changed. They're now quietly closing those shorts, taking losses where necessary, because they've recognized that fighting physical demand at this scale is suicidal. I have sources, traders who've worked precious metals desks for decades, telling me that internal risk committees at these banks have completely reversed their posture on silver. Positions that were considered safe hedges 6 months ago are now being classified as existential risks. Why? Because when physical demand from retail and sovereign buyers exceeds available supply, the paper market becomes irrelevant. The COMEX can show silver trading at $30, but if you can't actually buy physical metal at that price, the quote is meaningless, and banks holding short positions face catastrophic losses when the paper market converges with physical reality. If silver reprices from $30 to $100 because of genuine supply shortage, every ounce they're short costs them $68. At the scale these institutions operate, millions of ounces. That's billions in losses. Losses that can't be hedged away because there's no physical metal available to cover the positions. This is why they're exiting. Not because they've suddenly become silver bulls, because they've realized they're on the wrong side of a trade where physics trumps finance. You can't deliver paper promises when buyers demand metal, and when you can't deliver, you default. And banks don't default on commodity contracts unless forced to, so they're closing positions now while they still can. Now let me connect what's happening at retail level, Costco in America, households in China, with what's happening at the institutional level, because this isn't just a retail phenomenon, it's a complete restructuring of the silver market across all participants. Industrial users of silver, companies that manufacture electronics, solar panels, medical devices, anything that requires silver as a critical input, these companies are panicking. They've always operated on just-in-time inventory. They'd order silver from suppliers on 2-4-week lead times, get delivery, use it in production. That system is breaking down. Lead times have extended to 8-12 weeks for many industrial users. Some are being told 16 weeks or longer. And that's if suppliers will even commit to delivery dates. So industrial buyers are doing what they've never done before. They're stockpiling. They're ordering 6 to 12 months of silver inventory up front. They're willing to tie up capital, pay storage costs, accept price risk, anything to ensure they have metal when they need it. Because without silver, their production lines stop. And when your production line stops, you lose far more money than whatever premium you paid to secure supply. This industrial hoarding creates a feedback loop. The more companies stockpile, the less silver is available for everyone else. The less available, the more companies panic and order even more. Industrial demand, which is normally steady and predictable, becomes panic-driven and exponential. Add to that the retail demand explosion, Costco in America, Chinese households globally, and you have a supply-demand imbalance that cannot be resolved at current prices. The only mechanism that can slow demand is price. If silver goes to $50, casual buyers step back. If it goes to $75, more buyers exit. If it goes to $100, only industrial users who absolutely need it and wealthy investors who understand the long-term trajectory remain active. But here's the critical insight. Silver's industrial necessity means that price destruction, the level where demand finally drops enough to meet supply, is much higher than most analysts think. Because factories will pay $100, $150, even $200 per ounce if the alternative is shutting down production lines worth millions of dollars. Industrial demand is inelastic. It doesn't respond to price the way speculative demand does. This is why I'm telling you that silver's ultimate destination over the next decade could be $800 per ounce. Not because of speculation, not because of price manipulation ending, but because when you combine inelastic industrial demand, exponential retail demand from populations losing faith in fiat currency, and supply that physically cannot increase fast enough, the only equilibrium point is dramatically higher prices. Let me walk you through the timeline of how this unfolds. We're currently in phase 1, retail awakening. This is what we're seeing at Costco in Chinese households and increasingly in other retail channels globally. Regular people buying physical silver because they're worried about inflation, currency instability, economic uncertainty. This phase creates sporadic shortages, rising premiums, and extended lead times. But the broader market, the institutional market, the futures market, hasn't reacted yet. COMEX prices remain relatively stable. Phase 2, which I believe will enter in Q1 2026, is media amplification. As more retailers sell out, as more stories circulate about delivery delays and premium spikes, mainstream financial media covers it. CNBC runs segments. Wall Street Journal writes articles. Bloomberg reports on the physical premium divergence. This media coverage brings in a new wave of buyers, people who weren't paying attention before but now think, maybe I should get some before it's gone. This creates a feedback loop. Shortages drive coverage. Coverage drives buying. Buying creates more shortages. Phase 3, which could happen as early as Q2-Q3 2026, is premium explosion. The disconnect between COMEX spot price and physical price becomes undeniable. COMEX might show $40, but dealers charge $70, $80 for actual delivery. The premium, normally $25, is now $30, $40. Buyers are paying double spot to get metal. Smart institutional money notices this and tries to arbitrage. Buy silver on COMEX at spot, take delivery, sell physical at premium. But when they try to execute, they discover COMEX delivery is severely constrained. Registered inventory is too low. The exchange can't handle large-scale delivery requests. The arbitrage breaks. Phase 4, probably late 2026 or early 2027, is COMEX crisis. Delivery requests exceed available registered inventory. The exchange faces two choices: default on deliveries and settle contracts in cash, destroying confidence in the paper market permanently, or allow spot price to gap up violently to meet physical prices, potentially doubling or tripling in days. Either outcome is catastrophic for the existing price discovery mechanism. If they default, everyone realizes COMEX prices are fiction. If they gap up, it confirms the physical shortage is real and price suppression has ended. Phase 5, timing uncertain but inevitable, is government intervention. When the crisis threatens systemic stability, when it risks dollar confidence, commodity market integrity, industrial supply chains, governments step in. They might restrict trading. They might force cash settlement. They might attempt to ban or limit retail sales of physical metals. But here's the trap. Intervention validates the very concerns driving demand. If the government has to stop you from buying silver, it confirms silver is valuable and the system is scared. This makes people want it more. The Streisand effect. Phase 6, the ultimate resolution, is repricing. After the chaos, after shortages, after interventions, the market reprices silver to reflect physical reality. That repricing could put silver at $100, $200, $300 depending on how much confidence in paper markets is destroyed and how much capital flows into physical. But the $32 silver we have today will not survive genuine physical shortage. Price must rise until demand is destroyed. And given industrial necessity, factories that literally cannot function without silver, that demand destruction level is very, very high. This is the framework. This is how it plays out. And we're already in phase 1 transitioning to phase 2. The Costco event, the Chinese household buying, these are phase 1 signals. When CNBC starts covering it extensively, when your friends who know nothing about precious metals start asking you about silver, that's phase 2. And once phase 2 begins, the window to accumulate at reasonable prices closes rapidly. Now let me address the psychological barrier stopping most people from acting. You're thinking, this sounds extreme. Silver at $800 in 10 years? That's a 25x increase from today. That's impossible. But is it? Let's look at historical precedent. In the 1970s, silver went from $1.50 in 1971 to $50 in January 1980. That's a 33x increase in 9 years. And it did so in an era where information traveled slower, where retail participation was limited, where global supply chains were less complex, and where industrial demand was a fraction of what it is today. If silver could 33x in 9 years under those conditions, why is 25x in 10 years impossible under current conditions, which are far more conducive to explosive upside? The difference today is that silver isn't just a monetary metal, it's critical industrial infrastructure. Every AI data center requires massive amounts of silver for electrical conductivity. Every solar panel, and the world is installing solar at exponential rates, requires silver. Every electric vehicle requires 3 times more silver than conventional vehicles. 5G infrastructure, military applications, medical devices, all require silver in quantities that cannot be easily substituted. This means silver demand is not optional, it's not speculative. Factories and governments must secure silver at any cost because the alternative is production stops. And when must-have demand meets limited supply, price discovery becomes exponential, not linear. Exponential. Consider also that we're in an environment of currency debasement unlike anything in modern history. The US dollar has lost approximately 30% of its purchasing power since 2020 due to monetary expansion. Other currencies have fared worse. When people lose faith in currency, and retail silver buying is evidence of that loss of faith, they flee into hard assets. The more people flee, the faster currency weakens. The faster currency weakens, the more people flee. Another feedback loop. If the dollar loses another 40 to 50% of purchasing power over the next decade, not an extreme scenario given $36 trillion debt growing $1 trillion every 100 days, then a nominal silver price of $800 might only represent a real purchasing power gain of 5-10x, not 25x. You have to account for currency debasement when calculating returns in nominal terms. So when I say $800 silver in 10 years, I'm not predicting a fantasy moonshot. I'm projecting what happens when you combine industrial demand that must be met regardless of price, retail demand from populations fleeing currency debasement, supply that physically cannot increase fast enough, paper market collapse forcing price discovery in physical markets, and dollar devaluation making all commodity prices rise in nominal terms. Under those conditions, $800 is not only possible, it might be conservative. Some analysts I respect are modeling $1,500 silver by 2035 if the feedback loops accelerate. I'm taking a more moderate stance at $800, but the point is, directionally, we're heading far higher than most people can imagine. Now let's talk about China specifically, because this is where the game changes entirely. China isn't buying silver for speculation. They're not buying it because they think it'll go up 20% and they can flip it. China is buying silver for 3 strategic reasons, and understanding these reasons helps you see why this isn't temporary. First, China is de-dollarizing. They've been methodically reducing dollar exposure for years. They've cut treasury holdings. They've built alternative payment systems. They've established currency swap lines with dozens of countries. But converting dollars to yuan just means trading one fiat currency for another. Converting dollars to hard assets, gold, silver, commodities, means exiting the fiat system entirely. Silver, being cheaper than gold but still precious, allows broader participation. Chinese households who can't afford gold can afford silver, so silver becomes the de-dollarization vehicle for the masses. Second, China recognizes silver's industrial criticality. China produces 80% of the world's solar panels. They're the largest EV manufacturer. They're building out 5G infrastructure at unprecedented scale. They need silver, massive amounts of silver, and they know that Western financial institutions have suppressed silver prices for decades through paper markets. By encouraging their population to buy physical silver, China achieves 2 goals. They help their citizens protect wealth, and they drain Western-controlled supply, exposing the paper market manipulation and forcing repricing that benefits Chinese industrial and sovereign stockpiles. Third, China views this as economic warfare. Every ounce of physical silver that moves from west to east is an ounce the West no longer controls. Every Chinese household holding silver is a household that's more economically secure and less dependent on Western financial systems. Every premium dollar Chinese buyers pay above COMEX spot is proof that Western price discovery is broken. China doesn't need to attack the dollar with military force. They can attack it by convincing their population that hard assets are superior to fiat currency. And when 1.4 billion people act on that belief, the Western fiat system weakens accordingly. This is why Chinese state media is promoting silver daily. This is why financial advisors in Shanghai are recommending 10-15% silver allocation as standard practice. This is why Chinese households are being told to store silver at home and hold multi-generationally. This isn't investment advice, this is strategic resource competition disguised as personal finance guidance. And the scale is terrifying if you're on the wrong side. The Chinese savings pool is estimated at $20-25 trillion. If just 2% of that gets allocated to physical silver, you're talking about 400 and 500 billion of demand. At current prices, that's 12.5 to 15.6 billion ounces. Annual global silver production is 850 million ounces. Chinese savings alone at just 2% allocation represents 15 to 18 years of total global production. That demand cannot be met. Full stop, which means either Chinese buyers don't get the silver they want, unlikely given government backing, or the price rises until demand is destroyed, which takes us back to the $100, $200, $800 trajectory I outlined. Now, what should you do with this information? Because understanding what's coming is useless if you don't position correctly. Let me give you the action framework. First, if you don't own physical silver, the time to start is now. Not when CNN is running 24/7 coverage of silver shortages, not when your neighbors are lining up at coin shops. Now, when it's still available, when premiums are elevated but not insane, when you can actually get delivery within weeks rather than months or never. How much should you own? Financial advisors often recommend 5 to 10% of net worth in precious metals. If you have $100,000 in savings and investments, $5,000, $10,000 in physical silver is reasonable. But given what's coming, given what we're seeing in retail demand, Chinese accumulation, and bank positioning, I'd argue for the higher end of that range, or even slightly above if you understand and accept the volatility. Second, buy physical only. Not SLV, not silver mining stocks, not futures contracts, physical metal you can hold. Coins, bars, rounds, actual silver that exists in the real world. Paper silver is a claim on metal that may or may not be there. Physical silver is the metal itself. In a crisis, that difference is everything. Where to buy? Costco, if you can catch a restock, though based on the 72-hour sellout, you'll need to be fast. Online dealers like AppMex, SD Bullion, JM Bullion, Money Metals, all reputable. Local coin shops if you have them in your area. Just verify you're getting legitimate product. American Silver Eagles, Canadian Maples, and well-known private mint rounds are all good. 100-ounce bars have lower premiums if you're buying larger quantities. Third, accept that premiums are high and will likely go higher. Pre-2020, you could buy silver at 2 to 3 over spot. Today, you're paying $6 to $10 over spot for coins, maybe $3 to $5 for bars. That premium reflects supply tightness. It's the new normal. Don't wait for premiums to normalize, because they're not normalizing unless demand collapses. And if demand collapses, the crisis has passed and you missed the protection window. Fourth, expect lead times. If you're buying larger quantities, 500 plus ounces, you might wait 6 to 8 weeks for delivery. Some dealers are quoting even longer. That's fine. Lock in the price, wait for delivery. The Costco members who bought during the 72-hour window got in before the worst supply crunch. Be like them. Early, not perfect. Fifth, store securely. Don't leave silver sitting around, obviously. Get a safe, bolt it down, or use professional allocated storage where you have segregated holdings. Don't use bank safe deposit boxes. If there's a banking crisis, you might not access it. Keep it where you control it. Sixth, operational security. Don't tell everyone you own silver. Keep it quiet. Tell your spouse, your financial advisor if you trust them. But don't post on social media. Don't brag to friends. If economic conditions deteriorate, you don't want to be known as the person with precious metals. Seventh, prepare for volatility. Silver swings wildly. You might buy at $30 and watch it drop to $28. Don't panic. Don't sell. Remember why you bought. Insurance, protection, optionality. Those reasons don't change because price moved down temporarily. The Costco members aren't trading. They're holding multi-year, potentially multi-decade. That's the correct mentality. Eighth, dollar cost average if accumulating. Don't try to time perfect entry. Buy some now. Buy more next month, more the month after. Over time, you average out volatility and build position. This is what smart accumulation looks like. Consistent, methodical, disciplined. Ninth, stay informed. Watch what happens at Costco. If they restock and sell out again in hours, confirmation. If Chinese media keeps promoting silver daily, confirmation. If premiums keep rising, lead times extending, dealers running out, these are all signals the shortage is real and accelerating. And if signals keep flashing, act faster and more aggressively. 10th, prepare for the endgame. At some point this reaches critical mass. COMEX default, government intervention, currency crisis. When that happens, physical silver availability goes to zero. Dealers stop selling because they have no inventory and no idea when they'll get more. If you don't have your silver by then, you're not getting it. The window is now, not when CNBC runs specials about shortages, not when government talks about regulating precious metals now, when it's boring, when most people still don't care, when Costco is just starting to sell out instead of permanently sold out everywhere. Let me close with the big picture perspective because it's easy to get lost in the details and miss the forest for the trees. What's happening with silver right now, the Costco panic buying, the Chinese household accumulation, the banks closing shorts, the supply chain breakdowns, this is not primarily about silver. It's about the end of confidence in the post-1971 fiat currency system. When Nixon closed the gold window in 1971, the world entered an era of pure fiat currency. Money backed by nothing except government promises. For 50-plus years, that system worked because people believed in it, believed the dollar would hold value, believed governments would act responsibly, believed the financial system was stable. That belief is dying. Not among economists or analysts or gold bugs who've been skeptical forever, among regular people, Costco shoppers, Chinese households, the mainstream. When mainstream populations lose faith in money itself, they flee into things that can't be printed. Gold, silver, real assets. And that flight, when it involves billions of people across multiple continents, destroys the currency system they're fleeing from. This is what the banks see. This is why they're closing silver shorts. Not because they're bullish on silver as an investment, because they're terrified of being caught short a physical asset during a monetary crisis. They know that when faith collapses, paper promises become worthless and physical assets become priceless. The Costco silver panic is not an isolated event. It's a symptom of a much larger disease affecting the global monetary system. And symptoms that appear in the mainstream, that spread from Costco to China to Europe to everywhere, those symptoms indicate the disease is terminal. You can ignore the symptom. You can dismiss the Costco event as retail panic over nothing. You can assume the Chinese promotion of silver is temporary. You can believe the banks are closing shorts for reasons unrelated to existential risk. But if you ignore all these signals simultaneously, if you wait for more proof, you're going to wake up one day and discover that the window closed. That physical silver is unavailable at any price. That dealers are sold out indefinitely. That premiums are 10x what they are today. That the world has repriced silver to reflect its true scarcity and you're not holding any. The Costco members who acted during that 72-hour window, they made a decision. They saw something, trusted their instincts, and acted. In 10 years, when silver is $800 per ounce and the dollar has lost half its remaining purchasing power, those Costco members are going to look like geniuses. Not because they predicted the future perfectly, but because they recognized a pattern and positioned themselves correctly. Don't let hindsight be your teacher. Let what's happening right now be your teacher. Learn from Costco, learn from China, learn from the banks, and act accordingly. Because the next time Costco restocks silver, it might sell out in hours instead of days. And the time after that, they might not restock at all. The suppliers might not have metal to sell, the refineries might be backed up for months, the system might be broken beyond repair. This is not a prediction of what might happen. This is documentation of what is happening right now, today, while most people aren't paying attention. The panic has begun. The mainstream is waking up. And the smart money, the Costco money, the Chinese household money, the institutional money that's closing shorts, they're already positioning. The only question is, are you? This is William Lee. The window is closing. The shortage is real. And silver at $32 is not the top of this move. It's the bottom of a repricing that ends somewhere between $200 and $800 over the next decade. Position accordingly.